Welcome to Building Wealth in Real Estate, Block 2, Growing from 0 to 3 Properties. My name is Johnny Macias. I'm the founder and creator of the Real Estate Ladder, and I appreciate you joining us on Block 2. In this block, we're going to discover creating cash flow and understanding the real estate ladder, utilizing the owner-occupied method, and we're going to discover and review 3 real estate investing case studies. Welcome. This is block 2 out of a 3-block series. Block 1, building financial foundations. In block 1, we review a lot of credit, budgeting, and how to really plant the seed for buying our first property. Block 2, which we're going to review today, is going to be how to really grow from that 0 to 3 property. And block 3 is our advanced series. In block 3, we discuss a lot of terminology. We talk about analyzing deals, top ROIs, and as an investor, when would I want to invest in a certain property over another? Welcome to our 3-block series. My name is Johnny Macias. Professionally, I have been a mortgage lender in the state of Colorado for about 20 years now. Personally, I've been a real estate investor and landlord for a little over 20 years. And what I can tell you from my experience of being an investor, landlord, as well as being in the mortgage and finance industry is financial illiteracy is a real thing. The generational poverty loop is a real thing. I believe that we can break that loop by understanding the 5 core pillars of real estate. We call this the ideal investment: income, depreciation, equity appreciation, and leverage. We're really going to dive into that concept here in block 2. This not only gives us the confidence to buying house 1, 2, and 3, but it also gives us the system where we can duplicate. I wanted to start off by sharing this pie chart with us on the wealth distribution from 2025. This chart is actually from bankrate.com. And I want to point out, most of us are investing in our pension and our retirement accounts at the bottom of the screen, 25%. However, if we look at the primary residence at 25%, the house becomes one of the largest assets on our balance sheet. If we look above primary residence at that investment real estate at 11.4%, when we add owning investment real estate and our primary residence, this chart makes an argument that real estate becomes the foundation for building true generational wealth. I am an advocate for diversifying. I think to build true wealth, we have to have a combination of all of these. We have to own real estate. We have to own our own business. We have to have investment accounts and equity accounts and life insurance and retirement and mutual funds. We have to have all of these to really build the foundation that we're looking for to retire wealthy. Robert Kiyosaki is actually the author of a book called Rich Dad, Poor Dad. I think every investor on this planet has read Rich Dad, Poor Dad at some point in the teachings that Robert Kiyosaki talks about in the philosophies in this specific book have not only influenced me throughout my career, it breaks down the concepts of money on an elementary level. So therefore we can understand it and utilize it for ourselves easier. So Rich Dad Rules of Money, very first one is assets versus liabilities, understanding assets and liabilities. In the book, Robert Kiyosaki calls this good debt and bad debt. Good debt is debt that somebody pays for you. Bad debt is debt that you pay on your own. So a rental property, a mortgage on a house, is that good debt or bad debt? That's good debt because somebody else is paying it for you. Now, if you go finance a brand new vehicle, is that good debt or bad debt? Bad debt. That depends. For most of it, it becomes bad debt because we're using our money to pay for that liability. Understanding the difference between assets and liabilities as good debt versus bad debt. Understanding the ways of cash flow. In the book, Robert calls this the cash flow quadrant. The employee, the self-employed, the business owner, and the investor all have the same amount of time in the day. However, their relationship with money and the way they spend money and spend their time is different. An employee will exchange their time for a wage. Somebody who's self-employed will essentially buy a business. And when we say self-employed, a lot of the times we're thinking of small business owners. A business owner will learn how to leverage other people's time for their business. And an investor will learn to leverage their capital and their money versus their time. So the point that Robert's trying to make is that in order to create true wealth, we move through this model back and forth to generate our own wealth. Become familiar with your taxes. This is a subject that I often harp on, is filing your taxes the right way. And I always like to start off with, most of us have been taking advice from our equally poor friends. And our friends would tell us, don't claim your income to the IRS, because if you claim your income to the IRS, you're going to have to pay taxes. I'm here to now argue the point. That's what poor people do. Rich people, they claim their income, because when you claim your income to the IRS, you now have documentable income. And when you have documentable income, banks want to lend you more money. It's when you don't have documentable income, banks don't want to lend you money because you don't have any documented income or documented form on how to repay the money. So become familiar with your taxes, claim your income, learn how to utilize leverage. Many of us have played the game Monopoly. And in the game Monopoly, we take our 4 greenhouses on our properties and we exchange that or trade that in for a red hotel. In our industry, that's leveraging the one asset to buy another, or leveraging what's called a 1031 exchange in real estate. Learning to leverage is going to be crucial when you're looking at building wealth in real estate. Protect your assets, entities, trusts, life insurance, and wills. I'm going to really discuss the trust part in this presentation, but protecting your assets is going to include all of this. And get rid of cash, understanding the difference between inflation and cash flow and appreciation. In this presentation specifically, we're going to talk more about the appreciation side of real estate, but these would be great conversations to have with your financial planner. The flow of money. Now, what we're going to do is I'm actually going to bring up the example of an employee versus an investor. But before we start, I want to first ask the question, as employees, what is our boss's job? Is it our boss's job to look after our financial independence, or is it our boss's job to make sure that we're working 40 hours a week? It's our boss's job to make sure that we're working 40 hours a week. It's our job to look after our financial independence if that's what we choose. So there's nothing wrong with being an employee. For many of us, we start here because being an employee gives us the security that we need. It gives us the security of the income. It gives us the 401k match. It gives us the health insurance for our family. But it's very hard to get ahead when we're depending on a fixed income. An employee, before they receive their paycheck, they pay taxes first. Then they receive their earnings, they pay their bills, and often they have zero amount left over at the end of the month. Now, if I bring up our investor, they receive their earnings, they have an opportunity to reinvest in cash flowing assets first, then they pay taxes on whatever's left over. So the point that I'm trying to drive here is the way that our tax system is currently set up, it is next to impossible to be an employee and save yourself to retirement. These are inverted. An employee pays taxes first, an investor pays taxes last. The ideal investment. Ideal is an acronym that we use in our 3 modules, and we'll talk about it here in this module as well. And ideal is an acronym for income, depreciation or deduction, equity, appreciation, and leverage. These are the 5 core pillars to building wealth. So income, depreciation or deduction, equity, appreciation, and leverage. So we're going to see that throughout the series here. We're going to talk about a high level view of the real estate ladder before we dive into the examples. The very first thing that we have to do is we have to purchase house number 1. If you're not living in house number 1, that's okay. We can help you get into house number 1. After you live in house number 1 for 12 months and a day, you are now eligible to turn that house into a rental property. We can use the income that you're going to be receiving as a rental property to help you qualify for house number 2. So then what's going to happen is before we turn house number 1 into a rental property, we're now looking to identify and move into house number 2. And we're going to owner occupy this house. We have to owner occupy the house. That is declaring to the bank that we are planning to move out of house number 1 and we're going to establish house number 2 as our primary residence. When we move into house number 2, now we're going to start our LLC and our trust for house number 1. One LLC and one trust per house. So not only does this protect us legally, but this allows us the proper entity that we can set up to now start using our LLC as a business pass-through. So we don't want our tenants paying us rent directly. We want them paying the LLC. Therefore, we can properly document it and we can separate our business from our personal. So after we live in house number 2 for 12 months and a day, now we can start utilizing business credits to use the business credit to help us offload our consumer debt and transferring it out of our personal name into our business name. Essentially, what we're doing is we're getting ready to go buy house number 3. So now we're able to buy house number 3. We move into house number 3 while turning house number 2 into a rental property. And then we rinse and repeat. We start another LLC and trust for house number 2, and the process continues. That's the overview of the real estate ladder, how to grow from 0 to 3 properties and how to do it using the owner-occupied method. You have to move into the house. You have to maintain residency for 12 months and a day, and you have to declare that this is going to be your primary residence when you're doing this. Now let's see this in action. Thanks to our sponsor, Colorado Mortgage Connect, the first house will become the foundation of building wealth. The common thread that we see with working with mortgage clients and investors is that the foundation to their wealth was started by owning real estate. So the first home is really going to become the foundation to building wealth. I'd like to introduce us to John and Sally. We're going to be following John and Sally throughout the series of them buying their first 3 houses. John and Sally live in Anywhere, USA. They are a married couple. They have a household income of $120,000. Their goal is to build wealth and save for retirement. And John and Sally watch TV shows like HGTV's Flip This House and Property Brothers, and they read books like Rich Dad, Poor Dad. However, like many of us, John and Sally, they don't know where to go after that. They watch the TV shows, they've read the books, but maybe they don't have somebody in their sphere of influence that owns properties and they have questions. Case study number 1, we're going to watch John and Sally as they purchase their first home using down payment assistance. So here we go.
Meet John and Sally, a dynamic duo with a shared dream of owning their first home and venturing into the realm of real estate investments. However, they face a few hurdles on their path to home ownership. Like many, John and Sally encountered obstacles, understanding mortgage programs, credit requirements, and arranging the down payment, making their dream seem out of reach. Despite the obstacles, John and Sally didn't give up on their dream. They discovered the Colorado Mortgage Connect team that was providing financial education to first-time home buyers. Once John and Sally were able to meet with a trusted mortgage advisor, they felt relieved that they would be able to own their own home and qualify for down payment assistance. Once pre-approved, they were introduced to a local real estate expert. Their joint pursuit led them to a charming house, a perfect fit for their dreams. Here are the details. Current home purchase price, $350,000. CHFA down payment assistance, $12,250. Current mortgage balance, $337,750. Interest rate, 7.125% on a 30-year fixed-rate mortgage. Current PITI, $2,600 inclusive of $175 for property taxes and $150 for homeowners insurance. Monthly HOA fee, $25. Total monthly payment with HOA, $2,625. With the assistance of their mortgage advisor finding the right down payment assistance and newfound knowledge, John and Sally are one step closer to making their dream a reality. Stay tuned. Follow John and Sally's journey as they pave the way to owning their first home and explore future possibilities in the world of real estate investments. Now, Back to the presentation for the ideal investment breakdown.
First off, obstacles, mortgage programs, credit, and down payment assistance. Let's first touch on mortgage programs. Often we find that a lot of clients are frozen because they don't know that there are mortgage programs out there that can aid them with buying properties. So I tell clients and new investors in the real estate ladder, think of mortgage programs as financial tools. There are several different types of programs, and they're really designed on your down payment, your occupancy, your credit, your income. And there is a program for almost every single way that you can think of to structure a deal. So mortgage programs is usually the very first obstacle that we get to overcome. The second one will be credit. There's a big misunderstanding around credit. Don't allow credit to hold you back, because chances are you're probably credit qualified now. And if you're not credit qualified, this is something that we can actually help increase. If you have not seen block one, I would encourage you to go back to block one. We do talk about credit and how to increase your credit. Last is going to be down payment. One of the biggest misconceptions is that we need a 20% down payment. That's simply not true. So in order to do most of the financing for owner occupied loans will require anywhere from 3 to 5% of the purchase price as a down payment. That's money, that down payment can be borrowed in the form of down payment assistance, that can be leveraged from maybe another property that you own or a business, maybe a retirement account. That down payment can also come in the form of a gift. If you have a family member that's willing to gift you some or all of that down payment, there are several ways for us to utilize the down payment programs. From the video, I want to bring up the ideal breakdown. So again, ideal income, depreciation, equity appreciation, and leverage. First one, income. $0. They weren't making any money on the property because they're moving into it. They're living there. So they're making $0 on it, or at least for now. Depreciation. So this is going to be the total tax write-off that they may be eligible for. And so by them having this loan, they would now be able to talk to their tax preparer of potentially having $23,956 as mortgage interest deductibility that they actually get to write off against their total taxable income. Equity. So equity is going to be the amount of principal that is paid off of the loan each year. So by them having this house, they're looking at paying $3,349 a year directly towards principal. Appreciation. So this is going to be the market growth. The average rate of appreciation is about 4 to 6% per year. Now, if the average is 4 to 6%, we like to use a number of 3%. So again, average is 4 to 6%. We like to use 3%, not because we're negative thinkers. We're not a glass half empty type of organization. However, as an investor, I want to know, does this deal still make sense at a 3% appreciation? So at 3% appreciation, they're looking at about 10,500 in growth per year. And then of course we can leverage, meaning at some point down the road, they will be able to go to a bank and they'll be able to borrow the difference in equity if they so choose. And they can use that money to buy another property. They can use it to maybe start or buy a business. They can use it for debt consolidation. They can use the money however they see fit. Down payment assistance review. So do John and Sally qualify for down payment assistance? Absolutely. What is their exit strategy after 12 months? They'll have the option to either sell it or turn it into a rental property. Does this create generational wealth? Absolutely. And can John and Sally use this program again? Yes. As long as they are owner occupying the property, they will be eligible for the lower down payment programs of 3 to 5% down. Case study number 2. John and Sally need to either look at renting our place and buying new or selling our place and buying. So let's follow them on this journey.
Meet John and Sally, proud homeowners of a lovely house in Anywhere, USA. John and Sally family have outgrown their home after a few years of living in it and are now trying to figure out the best move for their family. John and Sally have dreamed of the idea of one day owning rental properties that would provide monthly income well into their retirement, as well as would provide them with the opportunity to pass down to their kids and grandkids one day. Now the decision: do John and Sally sell their home and buy new, or do they keep their home and turn it into a profitable investment? John and Sally are contemplating the possibility of keeping and renting out their home and turning it into a profitable investment. John and Sally have questions. Being a landlord comes with responsibilities. Property management, maintenance, tenant management, and dealing with potential vacancies can be a challenge. John and Sally seek help, experienced help from industry experts with proven track records. It's advisable for John and Sally to consult with the experts before making their next move. A trusted mortgage advisor with Colorado Mortgage Connect to discuss bank approval and how to properly document rental income. A financial advisor to discuss tax advantages, and a real estate professional to provide insights around market rent, current rental demand, and to complete a property analysis. After consulting with the experts, John and Sally are ready to consider their options. Let's look at John and Sally's situation. Current home value $381,500. Current mortgage balance $336,593. Current interest rate 6.125% on a 30-year fixed-rate mortgage. Current PITI, principal, interest, taxes, insurance, $2,451. Monthly HOA dues, $25. Total monthly payment with HOA, $2,476. After completing a market analysis with a trusted real estate professional, John and Sally feel comfortable asking market rent of $2,950. John and Sally should carefully consider their choices. Is renting out their property the right decision for them? Does this fit with their long-term goals? Are there any consequences if they decide to not proceed and consider selling? To make the best choice, John and Sally should continue to consult with the experts who can guide them through the financial implications, best practices, tax considerations, and market dynamics. Now back to the presentation for the breakdown of the ideal investment.
Let's talk about obstacles here. Let's bring them up. Property management and maintenance, multiple home loans, and the investor blueprint. Let's jump into this. Property management and maintenance. We have to manage our properties. If you're going to be a landlord, you're going to have to manage the property yourself and learn how to do that, or you're going to have to hire a property management company to do that, and that is going to be at an added expense. I like to ask new students, is this a business or is this a hobby? If this is a business, then we're going to treat this like a business. If this is a hobby, you just hope things work out for the best. So don't be afraid of the property management and maintenance piece. We need to get ahead of that, especially before you become a landlord. Owning multiple home loans. This is a big contributor to people not wanting to move forward because they simply don't understand, or they have a different understanding of mortgages as a debt or a liability. So as long as we are documenting our income from our properties, banks will continue to give us home loans as long as we have documentable income. And then the investor blueprint. The investor blueprint we're working on here at the Real Estate Ladder. So we would advise you to keep an eye out for the investor blueprint. From that video, let's look at the ideal breakdown. Now, John and Sally had kept their house, but they had decided to refinance before they actually ended up moving out of it. So by them refinancing allowed them to not only lower their interest rate, but it also allows them to increase their cash flow by having a smaller payment. So now that they have the opportunity to rent the property, they now are set up to receive about $554 a month of income. Now, a lot of people will ask, what do you do with this money? What I personally do is I like to save the money. I like to build up a reserve account in my LLC account. So therefore, if I ever need to make an insurance claim, or I need to buy a new furnace or a sewer ejection pump, I need to have a tree removed from the property. I'm not essentially using my money, I'm using money out of that business. I've heard other people say that they wanted to use this money, this cash flow from their tenants, to maybe pay off some high interest debt, or maybe they're taking the cash flow, they're investing it in high yield accounts, or maybe even paying off their own property. I've heard a combination of any of these. So income $554. We have a depreciation of 20,504. So remember, they get to write this off against their taxes. So the more houses they own, the more potential write-offs that they can receive. We have equity. So every year there's about $4,037 being paid off of the property. We have appreciation. So again, using that 3%, the lower side of the appreciation, the house should be appreciating about $11,445. And then of course we have leverage. So at any point down the road, as long as we have our documentable income, we can go and take out a loan. John and Sally review here. Do John and Sally qualify for an additional mortgage? Does this property meet the ideal breakdown? Does this help them with their dream of owning properties? And LLC and document income. Yes. Dude, how do John and Sally qualify for an additional mortgage? Remember, we get to use 75% of the proposed rental income from the house they're moving out of to help them offset that mortgage payment for buying house number 2. Does this meet the ideal investment breakdown? Absolutely. As long as there's income, depreciation, equity appreciation, and leverage, as long as we're positive in all of those numbers, it definitely meets my outlook on what a successful ideal breakdown is. Does this help John and Sally with owning rental properties? Absolutely. And LLC, EIN, and document income. We have talked about that. Creating the LLC, documenting your rental income, claiming it to the IRS, and creating that business account to do. There you have it. Last case study here. Now, John and Sally now want to buy an investment property fourplex that they may not be moving into. Let's see what happens here.
John and Sally have flourished in their beloved home, but with growing aspirations and a growing family, they're ready to delve into the realm of real estate investments to boost their wealth and monthly cash flow. John and Sally are interested in purchasing an investment property, specifically a fourplex. This new idea has brought forth new obstacles: accessing capital, understanding investment properties, and navigating the ideal investment. John and Sally reconnect with the experts, a trusted mortgage advisor with Colorado Mortgage Connect to understand financing options, a trusted financial planner to discuss options with leveraging existing assets, and an experienced real estate agent knowledgeable with investment properties to help market insights. After consulting with the experts and exploring the dynamics of investment properties, property management, tenant acquisition, and evaluating cash flow potential, John and Sally are ready to look for and analyze their next investment. Finally, John and Sally found the perfect fourplex to manage. Here are the details. Current purchase price $750,000. Down payment 25%, $187,500. Current mortgage balance $562,500. Interest rate 6.75% on a 30-year fixed-rate mortgage. Current PITI $3,648, inclusive of $225 for property taxes and $200 for homeowners insurance. Monthly HOA fee $0. Total monthly payment $4,073. After completing a market analysis with a trusted real estate professional, John and Sally feel comfortable collecting $5,800 per month. Estimated market rent $5,800. John and Sally are excited about this investment opportunity. They're poised to manage the fourplex, generate rental income, and strategically grow their wealth through the ideal investment. Stay tuned. Follow John and Sally's journey as they navigate the realm of investment properties and explore avenues to boost their wealth and financial freedom. Now, back to the presentation for the breakdown of the ideal investment.
Obstacles, liquid capital, multiple home loans, the investor blueprint. So did you guys catch the $187,000? That's the liquid capital. That keeps many of us from moving to the next stage of our investment because we don't understand how to leverage and when that comes into play, owning multiple home loans. Remember, mortgages are financial tools. There are specific mortgage programs that are set up to allow us to not only own multiple home loans, but also that give us the advantages of maybe not claiming or maybe not disclosing all of our income with a DSCR loan, or maybe there's fix and flip loans, or maybe there's hard money loans, private money loans. There are multiple loan options. And then again, the investor blueprint. Getting with us at the real estate ladder, getting with our team, having us help you or walk you through this is crucial. Okay, moving on. Let's look at the ideal breakdown. First up, income. Depreciation, $37,785 a year. Equity, $5,994 a year is being paid off the principal balance. Remember, good debt, bad debt. Yes, the landlord's carrying the debt. However, the tenant is paying off the debt for them. We have appreciation. Remember, 3%, $22,500 a year in growth. And then we have leverage, meaning at any point in the future, as long as we have credit, as long as we have our documentable income, we can go to any bank or credit union and we can look at borrowing or leveraging money against our properties and using that to either fund the next deal, buy a business, pay off debt, send our kid to college. We can access that money more easily by having assets more so than if we didn't. So there we have it, the ideal breakdown. First up, finding capital. Pension plans, family and friends, federal, state, local government, those are called opportunity zones. Life insurance, cash value. So if your spouse has life insurance, do not kill them, do not off them to receive the money, but you can access the cash value of the life insurance. If you have questions with that, I would encourage you to talk to your financial planner. 401k, seller financing, equity financing or HELOC, home equity line of credit, most popular. Credit card financing, usually don't recommend this one, but at some point in our careers as investors, we've all used credit card financing. I know I have. Hard money loans, those are going to be private loans. Creative financing and lease options. Money partners and mortgage brokers. Call it a Mortgage Connect. This is what they do. They help us find money. They help us discover different ways on how to leverage our properties, leverage our assets, how to increase our credit, and how to actually get credit worthy to buy that next property. Investment property review here. Can John and Sally access capital? Absolutely. Are there ways that increase rents? We didn't really talk about it in this block, and that is something that we will talk about in block 3 of what can I do as a landlord to actually increase our rents through either bi-monthly lease arrangements or renting out washer dryers, creating a storage unit facility that your tenants can rent additional storage units. So there are ways that we can increase rent. How does this create generational wealth? Adding another property definitely adds to that. And does this meet the ideal investment? I would say yes. Building block the wealth, leverage good debt, maintain great credit, create multiple streams of income. The average millionaire has 7 streams of income. Maintain current and accurate tax info. There's taxes again. Document your income. Business ownership. Going back to the cash flow quadrant, there's nothing wrong with being an employee, but we have to get into that business ownership. Equity ownership, owning equity in properties and businesses. Home ownership and the real estate ladder. Creating a savings plan, life insurance, 401k, IRA, stocks, bonds, mutual fund. Again, creating wealth is a combination of all of these. Real estate just happens to be the foundation. There you have it. Building blocks the wealth. With that, I would like to thank you, and this completes block 2.